Variable products. This is our preview video for our chapter on all things variable and all things insurance companies. Let's go ahead and get started with our Series 6 variable products overview. There are two main products issued by life insurance companies. They issue life insurance that has a death benefit, so we're benchmarking on the fact that someday we're going to die, while we have an annuity that has a life benefit benchmarking that someone is going to live. And so these two products are issued by a life insurance company. Let's first start by talking about an annuity. So there are two types of annuities that we want to introduce. The first is a non-qualified annuity. This is what you'll always assume on your Series 6 exam, is that an annuity is non-qualified unless they tell you otherwise. So when we have a non-qualified annuity, it is supplemental retirement income, and the exam is going to focus on this. With a qualified annuity, it's covered in retirement plans because it's qualified money that funds it. These are traditionally referred to as a 403B, or maybe you've heard them referred to as a TDA or a TSA, a tax-deferred annuity, or a tax-sheltered annuity. We're going to solely focus in this chapter on the non-qualified annuity. Exam is going to focus on this. With a qualified annuity, it's covered in retirement plans because it's qualified money that funds it. These are traditionally referred to as a 403B, but you may have heard them be referred to as a TSA or a TDA. Those two terms represent a tax-sheltered annuity or a tax-deferred annuity. In this chapter, we're going to solely focus on the non-qualified annuity. So, an annuity that's issued by a life insurance company can either be fixed or it could be variable. I wouldn't expect you to see a whole lot of questions referring to fixed anything on the Series 6 exam because in order to offer these securities, you also need to have a life insurance license. So we're just reviewing fixed annuities to get a better understanding and wrap our heads around a variable annuity. So investment risk, expense risk, and mortality risk for a fixed annuity are all retained by the insurance company. So with investment risk, they invest into the general account of the life insurance company, and they're not going to take a whole lot of risk. So usually they invest in U.S. government debt. Expense risk is the cost of maintaining the annuity. Mortality risk is the risk if the investor lives too long or dies early. All of the earnings in our fixed annuity continue to grow tax deferred. The money for the investor that they're putting in is put into the general account. They're investing into the general account that we just discussed. We generally see fixed annuities used for older investors or investors who are closer to retirement age and they can't assume a whole lot of risk, but they need their money really soon. So we'd go into a fixed annuity with those type of investors. Our exam, though, focuses on the variable annuity. So with a variable annuity, now the insurance company only retains the expense and the mortality risk. Earnings still grow tax deferred. And now the money is invested into a separate account. So the investor picks these different sub-accounts that works like a mini mutual fund because they're packaged instruments. So this variable annuity is used for younger investors who can assume some risk, who really wants to earn some extra money for retirement. Let's talk about variable annuity regulations. So variable annuity subaccounts are considered an investment company product, and they're regulated by the Investment Company Act of 1940. This act is the act that defines an investment company and sets up regulation for those companies. The Securities Act of 1933 is the one that goes over the new issue requirements. It's the first act governing the new issue primary market. The prospectus delivery requirements that are required for packaged instruments. With a variable annuity, not only do you have to have an insurance license, but you also have to have a securities license, like a Series 6 or 7. And the money has to be segregated or kept separate from the mutual fund or the fund itself, which is why we call them sub-accounts. So if the investor picks a different sub-account for their variable annuity, their money then first goes into the separate account and then to be divided by sub-account accounts that the investor chooses to put their money in. With our investor, they're younger. They've chosen a growth subaccount, a money market subaccount, a blue chip subaccount, and an index. Our investor, let's say, is investing 25% of their investment every month in these four packaged instruments. So types of accounts. A single premium immediate annuity is traditionally a fixed annuity. The investor is putting all the money in and they want to get the dividends right away. Putting all the money in and they want to get payments right away. Variable annuities are not suitable for that type of investor. So single premium immediate, we always assume that it's fixed. These are older investors who are ready to live off of income. Variable annuities lets the investor do a single premium deferred, which means I deposit a whole lump sum, but I don't take the money out for a few years. And I say a few, that's 10 plus years. Periodic payments, deferred annuities, that's where I'm putting money in on a periodic basis and deferring the payout until later. There are two different distinct phases for an annuity. We have the pay-in phase and the payout phase. The pay-in phase is referred to as the accumulation period, and we see younger investors use this to supplement their retirement. And just to give you an idea, when I say younger, we're really looking at that sweet spot for an investor between the ages of 40 and 60. Their kids have graduated high school, they're in college, getting ready to get out of college, and we have our home almost paid off. So those younger investors that are in that 40 to 60 zone who are experiencing that, those are the type of young investor that we would talk to about a variable annuity. And when they're putting their money in, they're buying accumulation unit and they're funding their annuity as the investor with after-tax dollars. It grows tax deferred, and you invest more money, you get more units. So as you buy in, you're accumulating accumulation units, hence the name accumulation phase. So with all investors, when we put money into an annuity, and we always want to take money out, right? So let's talk about taking money out of your annuity after the age of 59 and a half. So remember, 59 and a half is the age where we say that it's okay to take retirement plan money regardless what type of plan it is. So the investor can either do a lump sum distribution, a partial withdrawal, or they can annuitize. With a lump sum distribution, they're closing out their annuity. The cost basis is not taxed. And so remember this from investment companies, the cost basis for a security is the total purchase price for the security with after-tax dollars. So we never have to pay tax on that cost basis again. That means if we do a lump sum distribution, only the earnings are going to be taxable at withdrawal, and they are taxed at ordinary income. A partial withdrawal can also be referred to as a single distribution. And this means that the investor has not done a lump sum, nor have they annuitized, but they are just taking a payment every once in a while. Or maybe they're even taking payments over the course of a couple months, but they're not annuitizing. So with a partial distribution, the IRS always assumes LIFO, which stands for last in, first out. The last shares that came in or the first shares that go out. And we always assume that anyone taking money out of their annuity after the age of 59 and a half is doing a partial withdrawal unless this test or they tell you otherwise. So you always assume that single distribution. If the investor annuitizes, they exchange a lump sum of money for payments for life, and their payout at tax time is blended. Part of it is a return of their cost basis that they've already paid taxes on, and the other portion is the earning taxable in the current year. What is the variable annuity death benefit during the accumulation phase? This is where a lot of students fall prey to tricky questions on the test, so take some notes here. If the annuitant dies during the accumulation period, when they're getting accumulation units regardless of their payout option, that doesn't come into play until they annuitize. But if they die during the accumulation period, the death benefit for the beneficiary is the greater of the contributions made into the plan, or the market value on the investor's date of death. Remember that no payout option here. The payout options don't even matter until we've annuitized. So what does it mean when we say that the investor annuitizes? They're going into what we'd call the annuitization phase or the payout phase. So the investor will take all of their money from the accumulation period and they exchange that for a lump sum of money for the rest of their life. So two things that will be taken into consideration on the test is the assumed interest rate, or the AIR. I'm going to come back to that and talk about this more in detail on the next slide. And the other thing that we look at now finally is the payout options. The four types of payout options include straight life. And with straight life, there's no beneficiary. This is the highest payout options of all options available. When I sell these, I say that straight life is only for the investor that has no beneficiaries and I don't want to leave any money to charity. Because with straight life annuities, there's no beneficiary on the account. It is the highest payout monthly for all options, but to be honest with you, it carries the most risk. So that just simply means that the investor annuitized and they have $1 million in their account, they take their first payment for $5,000 and then a week later they die, the insurance company would keep all the money left over in the account. And that's a lot of money. So then we have life with a period certain. Period certain is around 10 years for most annuities. And it simply means that if the annuitant or the investor dies within that 10-year period certain, his or her beneficiary will get the remaining payments for the remaining period as if they were the annuitant. How is that different from unit refund life? With unit refund life, there is no time frame. When the annuitant or the investor dies, right? So I'm trying to get used to the term annuitant. Once we annuitize, that investor is called an annuitant. And with unit refund life, if they have invested when they've taken withdrawals for 4 years and then they die, if there is any remaining unit value, regardless of time frame, we send that out in a lump sum to the beneficiary. So life with period certain, there is a time frame that we consider that we need to look at in order to pay a beneficiary. With unit refund life, there is no time frame. Any money left in the variable annuity goes directly in one check to the annuitant's beneficiary. Joint and last survivor is just a way for us to have two owners on the annuity. So let's take a look at the assumed interest rate. And performance. The payout will fluctuate because we're still investing in the market by the way of our sub-account. The payout is going to fluctuate then, but the assumed interest rate is fixed. So with the actual performance of the separate account or the sub-account, if it's the same as the assumed interest rate, the investor's payment in dollars this month is going to be the same as last month. If the actual performance is higher than the assumed interest rate, the payment in dollars is higher than the last month payment. And if the actual performance is lower than the assumed interest rate, the payments for this month are going to be lower than the last month payment. Let's take a look at an example of how this works. So here you'll see we have an assumed interest rate of 5%, right? So the investor has a 5% assumed interest rate. That interest rate that is assumed will always remain fixed. So if we see this, it goes through February, March, and April. So in January, our performance was the same as the assumed interest rate, and the investor got $1,000. So what happens is that the investor now has been paid for January. So they no longer care about the performance and the ARR related to January. All they care about when we come into February is the performance with the assumed interest rate. So is this 7% higher or lower than 5%? Well, it's higher. So our payment in February is $1,200 because it should be higher than the last month payment. We've been paid in February, so let's get rid of it and look at March. In March, our performance again is 7%. It is higher than the assumed interest rate. And so remember, the payment in dollars is going to be rolling based upon that relationship in the current month. So is the performance higher, lower, or the same as the assumed interest rate? It's higher. So now the payment for March is going to be what? You got it, higher than the last month's payment of $1,200. It will never go back to this $1,000 unless it happens by chance. Then in April, we've been paid for March. We don't care about the performance anymore. April, the assumed interest rate and the performance are the same, so the payment for April is going to be the same as the last month payment. Now, let's take a look at the payment example with the assumed interest rate if the performance actually goes down in the market. So again, we're starting off here with an assumed interest rate of 5%, so that never changes. The performance in January is 5%. The investor gets $1,000. We've been paid for January and we no longer care about it. We come to February. The assumed interest rate is 5% and the performance is 4%. So the performance is lower than the assumed interest rate, so your payment for February is lower than the last month payment. Now we're paid for February and we go to March. In March, the performance and the assumed interest rate are the same. So that means in March, your payment is going to be the same as the last month's payment. Then in April, your performance is lower than the assumed interest rate, so then your performance is again lower than the last month payment. I don't ever expect for you to have to know how to do these in order to calculate the actual number. You're going to use the process of elimination, and they're going to give you a ballpark, like what should the performance be in comparison to the last month. So you have to understand the relationship here. You're not going to have to actually do the math because 3 of the answers likely will be clearly wrong. Let's look at life insurance. Again, in life insurance, similar to variable life insurance, I don't anticipate for you to see a lot of questions on fixed life insurance. Term life has no cash value. It's temporary insurance, pure insurance that expires. And if we're older, then we have to renew the insurance if we're closer to dying, so it's going to cost more in the future. Whole life is a permanent insurance that builds cash value that you can take a loan against, and it is not a security. Universal life insurance is like term life with a fixed annuity because the premiums become flexible. The cash value grows, we can take a loan against it, or use some of the cash value to pay down our premium, which is why we call that flexible. Now I want you to really understand how the difference between term life and whole life works. So I'm going to go into this a little bit. Now whole life insurance, I want you to understand, because if you ever are offering whole life insurance as an agent, or you're doing it a service to somebody, because eventually in the older years, the home's paid off, the kids are in college, and you're now self-insured. So why are we still paying on a whole life policy if you can be self-insured? Now here's the thing. The agent comes to a family and tells them, we're going to fill 2 buckets. We'll fill a life bucket and an investment bucket or a savings bucket. But what they don't tell the client is for the first 2 to 5 years of owning this product, none of that money is going to go into savings. Now think about it this way. If you had taken $100 a month out of every check to the bank for the last 5 years, and you go to the bank and are like, hey, I'd like to pull some money out, and they're like, we don't have any money here, would you bank with that product? I mean, you'd probably be flipping tables and lose your mind, so it's just absolutely ridiculous that they save that way. The second thing about how a whole life product works on the client's behalf, I want you to understand this, is that if something were to happen to you, let's say an agent would come out to your family and say, hey, I'm so sorry for your loss. Bob had $150,000 in his life policy and $100,000 in his savings. Which one do you want? And the family goes, well, we want both, right? And the agent goes, I'm so sorry, you only get one, you never get both. It says it right there in the policy. So it doesn't even matter that they were putting any money into savings anyway, because at the end they were just planning on appropriating those funds. So the proper product for people in the insurance industry to benefit the client and not go to make the salesperson the most money, right? Because for those first 2 to 5 years that you don't get any money put into your savings with the cash value life insurance, that money actually went to pay the insurance agent. Okay, so term policy is pure insurance that renews after a specific term, typically at a higher cost. But if you still need the insurance, you're protecting your family for 3 times the coverage for 1/3 of the cost. I mean, it's a solid deal. I can get behind that, right? But let's say that something were to happen to you. So we'd come out to your family and, we'll say, hey, Bob had $300,000 in coverage, and he also has this investment account, which you can let continue to grow. You can pull, you can really do whatever you want with it. You're listed as a beneficiary, right? So we teach people buy term insurance, pure insurance, and then, so you're protecting your family in case of the loss of income, right? You are the income. If you earn $50,000 a year, over the next 20 years, you're $1 million asset to your household. So in order to protect what would be devastating to your family, we want to take $80 a month or $100 a month sometime out of your salary, your $50,000 a year salary. So that turns out to be like $4,600 a month. If we just take 80 of it, we can protect what would be devastating in the loss of that income, right? So term insurance, we teach people to invest the difference. So we can save money by buying term insurance. It's less expensive than a cash value policy, right? But We teach them to invest the difference, what they would have been paying over there, into a completely separate mutual fund account. And mutual funds have averaged 10 to 12% a year for the past 70 years. So obviously a better option for the client to become, to eliminate the need for life insurance. What insurance company do you know that teaches people to eliminate the need for life insurance in their older years? Whole life agents rather you keep paying until you die. It's not what's best for the client. Now that you understand the difference between whole life and cash value life, I want to add one more thing too. We mentioned you could take a loan against the policy. In what world should you pay to take a loan of your own money? You have to pay interest back into the policy to take a loan out of your own money. So you could loan the money, you have to pay it back in with interest. Does that sound like a good product? No. So don't buy whole life insurance. In fact, if you ever see someone trying to sell it, make sure you can explain to them how it works, because it's not the best interest of the client. And these agents should be ashamed of themselves, an absolute abomination to the entire industry. Whole life is a permanent insurance that builds cash value you could take a loan against. It is not a security. Universal life insurance is like term life with a fixed annuity because the premiums become flexible. The cash value grows, you can take a loan against it, or you can use some of the cash value to pay down your premium, which is why we call that flexible. I anticipate for us to see questions on variable life. So with traditional variable life insurance, the money grows in the account, so the cash value of it will grow. It can even grow much higher than the death benefit. We can borrow up to 75% of the cash value as a loan, and remember, loan proceeds are not taxed. If the separate account performance deteriorates, then the investor may have to pay the loan back, but they're really paying back themselves with interest. Doesn't make a lot of sense. There's also no taxable events, and there's different investment options. So you get different sub-accounts just like a variable annuity. And now because of the package, we are now having voting rights, just like a mutual fund shareholder. With variable universal life, it's term life with a variable annuity. It's very flexible. The cash value will grow, and you can borrow again up to 75% of the cash value. And that loan, if you have to repay it, you're paying yourself at interest. You can borrow against it. There's no taxable event. It has voting rights. And now we have our different investment options. So it's very much the same. The difference is with variable universal, the premiums are flexible, which within variable life, they are fixed. So variable life insurance has this free look period. So if you're an investor and you have a variable life policy, and you're thinking it's maybe too aggressive, you don't like it anymore, you want to convert the policy into whole life, you can usually do that without any actuarial procedures, because when we take out life insurance, people at the insurance company called actuaries that assess our mortality. So it's really beneficial in the first 2 years. If we don't like the variable, we can go right into a whole life policy without having to go through what we call evidence of insurability again. And the other big benefit to a free look period is that there's no penalty. Variable policy calculations, a death benefit is calculated on an annual basis. Cash value is calculated monthly, and the net asset value, the NAV, is calculated, the price every day is calculated daily at the close of market. The last thing that I want to talk to you about is a viatical or a life settlement option. These are usually done by the insured, who's also the policyholder, and they're terminally ill. So with a viatical settlement, a third party or a company comes in and takes over the beneficiary slot and starts making all the monthly policy payments, and in return gives the policyholder / insured a lump sum of money to live out the rest of their life. The third party then is going to make all those premium payments, so when the insured dies, the third party gets the death benefit. So what's the problem if you're the third party? They still have to wait until the insured dies in order to get the money. That's it, you guys, for this section of the video. Everything that we really need to know about life insurance and annuities. I encourage you now to go over to millionairesintraining.com and focus on our testing simulation for variable annuities. Take some notes and complete your practice questions and review the explanations. Try and get higher scores, and I look forward to seeing you back in our next section of the video. Have an excellent day, and I'll see you soon. Take care. It's been my pleasure to be on this call with you this evening. Work hard, because you could become a millionaire made at millionairesintraining.com.